International Monetary Fund Managing Director Kristalina Georgieva warns that the global economy has entered an era of persistent, compounding shocks, moving away from historical periods of relative stability. This waterfall chart tracks the immediate impact. Fitch Ratings has downgraded global growth expectations to 2.4%, citing the 14-week closure of the Strait of Hormuz as a primary drag on consumption. Economic activity is currently fracturing into isolated pockets of localized growth, alongside severe systemic contraction in global trade. In Europe, the European Central Bank is expected to lift its benchmark interest rate by 25 basis points this week, despite data showing 2 consecutive months of manufacturing contraction. This higher-for-longer rate environment is draining speculative liquidity from the global market as capital seeks safer yields. The reaction has been violent. South Korea's KOSPI index suffered a brutal intraday drop of nearly 8%, while the broader digital asset ecosystem lost $2 trillion in market value from its peak. High refinancing costs are also impacting property markets, causing commercial real estate yields in key hubs like Frankfurt and Paris to decouple from historical trends. Stubborn central bank policies are now applying direct pressure to valuations in speculative and debt-reliant asset classes worldwide. This map highlights the Strait of Hormuz, where conflict has doubled standard war risk premiums for shipping lanes. To avoid fees, cargo lines are rerouting fleets around Africa and South America, incurring multi-week delays and increased fuel costs. This logistics-driven inflation is prompting major developing economies to expand protectionist export quotas on staple grains and fertilizers. Maritime choke points are now directly inflating raw commodity prices and threatening food security in import-dependent regions across North Africa and the Middle East. While Western growth slows, China has upwardly revised its growth projection to 4.6%, driven by manufacturing dominance in semiconductors and green tech components. This comparative bar chart tracks China's growth alongside a 30% surge in U.S. capital goods imports, as American corporations front-load automated machinery to insulate against proposed tariffs. In Germany, a pivot toward domestic defense contracts is adding 0.8% to total GDP, helping the economy stave off a deeper technical recession. These shifts in the U.S. and Germany demonstrate that industrial activity is increasingly reliant on aggressive domestic automation and localized defense spending to bypass raw material and trade volatility. This diverging trend line shows enterprise AI demand pushing global semiconductor sales up 80% year over year, even as broader consumer electronics remain sluggish. This relentless hardware demand is generating massive trade surpluses for major exporters like Taiwan and South Korea. However, the mining sector warns of a severe copper deficit as AI data center grids and green infrastructure rollouts push spot prices to historic highs. While AI demand masks broader manufacturing weakness, these physical supply shortages threaten to delay critical infrastructure projects by up to 18 months. The current macroeconomic environment remains sensitive to supply chain shocks and hostile towards speculative asset classes. Corporations should pivot capital allocation toward physical supply chain resilience rather than relying on periods of global stability. Securing raw commodity futures and internalizing automated manufacturing are now the primary mechanisms for maintaining operations against the compounding shocks ahead.